Most people dream of retiring with a substantial 401k or IRA balance. However, there's a counterintuitive reality many don't anticipate. Multiple studies from Morningstar reveal that retirees entering their golden years with $1 to $3 million in traditional tax-deferred accounts may end up paying more in lifetime taxes than they did during their working years. This isn't the result of poor planning or insufficient savings. It's how the U.S. tax system is structured to penalize large traditional account balances. Some might assume only a small minority accumulates this level of wealth. And while that's true for the general population, it's common among disciplined savers. The research backs this up. According to Fidelity's Millionaire Outlook, nearly 80% of millionaires built their wealth through regular employer income and consistent investing, the classic 401k and IRA approach. Ramsey Solutions' national study of millionaires found that 93% built wealth in ordinary professions: teachers, engineers, IT managers, healthcare workers, government employees, skilled tradespeople, and military personnel. These weren't people who received windfalls or inheritances. They simply saved and invested consistently over time. The WealthX Global Wealth Census confirms that 76 to 80% of U.S. millionaires accumulated wealth through employment, disciplined saving, and investing, rather than entrepreneurship or inheritance. While $1 to $3 million may sound substantial, the data clearly shows millions of everyday Americans will retire with seven-figure balances, primarily in tax-deferred accounts. These are precisely the people Morningstar is warning about. Morningstar's research team has consistently demonstrated that retirees with $1 to $3 million in tax-deferred accounts often face the highest lifetime tax bills among all saver groups. Not the ultra-wealthy or high-income executives, but the consistent, disciplined savers who unintentionally create this tax burden. The core issue emerges in your early 70s when the IRS takes control of your withdrawal schedule. Until that point, you can withdraw as much or as little as you want from your 401k or IRA. Once you reach RMD age, currently 73, eventually increasing to 75, that freedom disappears. Required minimum distributions, RMDs, are mandatory annual withdrawals the IRS forces from traditional retirement accounts, regardless of whether you need the money. It's the government's way of finally collecting taxes you've deferred for decades. The required withdrawal percentage increases every year. Even if you're frugal, have other income sources, or don't want the money, you're required to withdraw tens of thousands of dollars, all taxed as ordinary income. You no longer control your withdrawal amounts. RMDs make that decision for you. This is where tax problems begin and why Morningstar continues issuing warnings. Consider a couple entering retirement at 65 with $1.5 million in a traditional IRA. They're modest spenders, planning to withdraw approximately 4% annually, roughly $60,000. They assume they'll take what they need, keep taxes low, and let the remainder continue growing. Here's the problem. Even while withdrawing $60,000 annually, the portfolio continues growing. In many Morningstar models, it reaches $1.8 to $2 million or more by age 73. Their first RMD could easily be $75,000 to $80,000, or even $90,000. Add in Social Security, perhaps another $50,000 combined, and suddenly they're pushed into higher tax brackets. Up to 85% of their Social Security becomes taxable. They trigger IRA Medicare surcharges, and their marginal tax rate can spike to 27.75%, or even 46.25% because of the tax torpedo. Morningstar repeatedly warns that middle affluent retirees with balances in the $1 to $3 million range face the highest lifetime taxes, not because they're wealthy or overspending, but because they're forced to recognize income they neither needed nor wanted. Many people miss this crucial detail. RMDs start relatively modest at roughly 4%, but increase every single year. If you're only withdrawing the minimum, your portfolio likely grows faster than your withdrawal rate. Morningstar's modeling consistently shows these balances growing well into your 70s, 80s, and 90s. RMDs get larger each year, and the taxable income problem compounds annually. What begins as a manageable RMD transforms into a growing, accelerating tax burden that disciplined savers often don't see coming until it's too late. The tax torpedo is one of retirement planning's most misunderstood concepts. When you withdraw money from a traditional 401k or IRA, that money is taxable. That's straightforward. The twist is that those withdrawals can also make more of your Social Security taxable. One extra dollar withdrawn doesn't just count as $1 of income. It can drag up to 85 cents of your Social Security into taxable income simultaneously. Two main danger zones exist. The first is the 27.75% marginal tax zone for people who believe they're in the 12% bracket. Here, each $1 of additional IRA withdrawal causes up to 50 cents of Social Security to become taxable. You're being taxed on $1.50 of income for every dollar withdrawn. With a 12% federal bracket, plus state tax or other phase-in effects, the real marginal tax rate reaches approximately 27.75%, despite your bracket showing 12%. The second is the 46.25% marginal tax zone for those who think they're in the 22% bracket. This is the bigger spike. Each $1 of 401k or IRA withdrawal causes 85 cents of Social Security to be taxed, meaning you're taxed on $1.85 for every dollar taken out. The 22% bracket, combined with state tax, IRMA cliffs, and credit phase-outs, effectively puts you at a marginal rate around 46.25%. It's not that the bracket itself is high, it's that two taxes hit the same dollar simultaneously. This double taxation creates the tax torpedo. This explains why many retirees wonder why they're paying more in taxes now than when they had a paycheck. The combination of Social Security taxation and RMDs creates a perfect storm of hidden taxes. Most retirees don't intentionally end up here. They were simply disciplined savers who use tax-deferred accounts. This is the group Morningstar calls middle affluent. As your traditional IRA or 401k grows while you're only taking minimum withdrawals, your tax torpedo exposure grows right along with it. Many retirees assume the tax torpedo affects only the wealthy, but that's incorrect. In fact, the wealthy often skip right over it. The tax torpedo doesn't hit couples with $70,000 pensions, six-figure RMDs, $3 million plus accounts, and high steady income. These households already have 85% of their Social Security taxed, so there's no phase-in left to trigger. Their marginal rate is simply wherever they're sitting. They've moved past the tax torpedo. The real impact falls on disciplined savers who have saved consistently for decades and spent modestly, built $1 to $2 million mainly inside traditional 401ks and IRAs, no large pensions, and rely on a mix of Social Security and IRA withdrawals, and income typically ranging from $40,000 to $120,000, the Social Security taxation phase-in zone. This is where the torpedo hits with full force. In this range, Social Security moves through three stages, from not taxable to up to 50% taxable to up to 85% taxable. Every extra dollar pulled from a traditional 401k or IRA pulls more Social Security into taxation. That's why $1 can be taxed as if it's $1.50 or $1.85. Someone who believes they're in the 12% bracket ends up paying approximately 27.75%, or someone who believes they're in the 22% bracket pays near 46.25%. They never see a 27% or 46% bracket, but they feel it when the tax code hits those dollars twice. Who doesn't feel the tax torpedo? Anyone whose income is already high enough that their Social Security is fully taxed at 85%. This includes retirees with large pensions, very large RMDs, and high investment income. For them, there's nothing left to phase in. Every additional dollar is simply taxed at their rate. They've skipped right over the tax torpedo. The middle-income retiree who gets hit has moderate RMDs of $30,000 to $80,000, Social Security of $20,000 to $70,000, no large pension to push Social Security fully taxable, income low enough that Social Security is still phasing in, and a nest egg built through consistent saving, not high earnings. This describes teachers, nurses, engineers, federal employees, small business professionals, mid-level managers, and everyday savers with $1 to $1.5 million in retirement accounts. They were responsible, did everything right, were disciplined savers, and they're the ones who get hit with the tax torpedo. There is absolutely nothing wrong with saving in a traditional 401k or IRA. For many people, the tax deduction makes saving possible in the first place. However, decades of retirement research point to the same conclusion. For many workers, especially those whose income grows over time, adding Roth into the mix early in your career can dramatically improve your long-term tax picture. The Roth offers several powerful advantages. You pay taxes when you're younger and often in lower tax brackets, avoiding higher taxes when your income's higher, when RMDs are in play, or when Social Security factors in. Roth accounts have no RMDs, meaning you're never forced to take money out. When money comes out, it's not considered ordinary income, completely tax-free. It doesn't influence RMAA surcharges or how much of your Social Security is taxed. Medicare premiums increase if your income crosses certain thresholds. Roth withdrawals don't count as taxable income, keeping Medicare costs lower. Traditional accounts dictate when and how much you must withdraw. Roth accounts don't. You can pull money out and spend it. Let it grow. Use it as a buffer for tax-free income when you don't want a high-income year on record. Save it for future healthcare costs, or leave it to heirs tax-free. Morningstar's analysis routinely shows those who use Roth early in life and then strategically use Roth conversions later end up with more spendable income in retirement and a lower lifetime total tax bill. The core idea is simple. When you pay tax matters just as much as how much tax you pay. Paying taxes when you're younger and in lower tax brackets means avoiding them later in retirement, when RMDs may push you into higher brackets. More of your Social Security could become taxable. IRMAA might trigger, and you have fewer tax planning years left. You're not just saving money, you're avoiding a forced tax bill when you want it least, in your 70s and 80s. Even if you spent most of your career contributing to a traditional 401k like most Americans, there are still powerful ways to reshape your future tax bill. Morningstar's research is clear. The years between retirement and your early 70s are one of the most valuable tax planning windows you'll ever have. Your income tends to drop dramatically once you step away from the workforce. Your paycheck stops. You may not have claimed Social Security yet, and RMDs haven't started. This creates a rare period, perhaps 5, maybe 10, maybe 12 years, where your tax bracket is the lowest it will ever be again. This is where Roth conversions become incredibly powerful. Rather than waiting for RMDs to kick in at 73 or 75, you take advantage of this low bracket period and move money from your traditional account into a Roth, paying taxes at a lower rate. This is exactly how retirees shrink future RMDs, reduce the tax torpedo, avoid IRMAA surcharges, and lower lifetime tax bills by tens or even hundreds of thousands of dollars. Roth conversions let you take control of your tax destiny rather than letting the tax code dictate it. Earlier, we saw how the tax torpedo unfolded for a couple with $1.5 million in a traditional IRA. Let's look at what could have happened. The version Morningstar's research often highlights. The tax problem we walked through wasn't unavoidable. It was predictable and preventable. If they had used some Roth earlier, even directing a portion of contributions into a Roth during lower earning years early in their career, they would have reduced the size of the IRA that later grew into a tax problem. Small Roth contributions early means smaller forced withdrawals later. If they had blended pre-tax and Roth savings, they would enter retirement with flexibility instead of everything in a single tax bucket. With multiple account types, they could choose how much taxable income to take each year, rather than having the IRS choose for them. If they had done modest Roth conversions in their 60s, the biggest opportunity most retirees miss, the impact would be substantial. The years between retirement and RMD age, before Social Security starts, are often the lowest tax years of someone's adult life. Even converting $20,000 to $40,000 annually in this window shrinks the future IRA balance, reduces RMDs, keeps more Social Security tax-free, lowers the chance of triggering RMAA, and dramatically cuts the lifetime tax bill. Roth conversions between retirement and RMD age often reduce lifetime tax bills by 6 figures. The reality is their IRA grew from $1.5 million to around $2 million at RMD age. Their RMD is now $80,000 to $90,000 or more. Up to 85% of their Social Security becomes taxable. Higher brackets kick in, RMAA may apply, and lifetime taxes compound year after year. What if they had followed a Roth path? The IRA would be much smaller by age 73. RMDs could be substantially lower, perhaps $40,000 or $50,000. Far less of their Social Security would be pulled into taxation. They would have lower Medicare premiums and a dramatically reduced lifetime tax bill. The difference isn't just about taxes, it's about control. The Roth account lets you decide when to take withdrawals, how much to take, and which bracket you end up in. With only a traditional account, that control is out of your hands. If you're in your 30s, 40s, or 50s, consistently saving, and looking at traditional accounts on track to grow to 1 million, 2 million, or 3 million, the research is clear. Do not enter retirement with all your wealth in traditional accounts. It might feel tax efficient now. You capture the deduction, your take-home pay looks higher, it looks great on paper. But later in life, that efficiency could flip and become one of the biggest tax problems you'll ever face. A balanced approach, Roth, traditional, and taxable, gives you options. It gives you the ability to manage when and how you realize income, control what bracket you end up in, and ultimately makes your retirement safer, more flexible, and far more predictable. The goal isn't just to save money. It's to save money in the right places, so your future self has choices. You work too hard building up your accounts to have the IRS dictate them entirely. The goal isn't to retire with a big number, it's to retire with control. The sooner you start building multiple buckets, the more control you'll have over your planning and your retirement.